Thanks for joining us today here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker and Scott Kirshner. And myself, my name is Chris Swan. Here's how you reach out. 419-794-3030 is the number. 419-794-3030. Headquarters.com. Whether you are a long time, you've been with us for a while, or you're tuning in for the first time, we really do appreciate you taking the time. Nolan and Scott, appreciate you guys taking the time as well. Nolan, welcome back, by the way. How are you guys doing today?
We are doing great. I think everybody else here in Northwest Ohio, just trying to get through some cold weather. And I guess I can have a little bit of snow, but I'm not too big of a snow fan. So I was able to get away out of town a little bit, and good to be back and in the hot seat, as they say. So,
yeah, I've got the gray beard going. I don't know if that's in tribute to my dad, who had a Santa Claus beard, or if it's just to keep some fur on my face to keep me warm. It's cold here, and I know you got back from Jamaica and Florida, and I know it was in the 80s there, but it's cold here. But we're doing very well.
Well, good. Glad to hear it. It is a little different from the warmer temperatures. And again, just a reminder, in retirement, it's not always going to be sunny and 70. You're going to have your cold days. You're going to have your rainy days. So you want to go and have a plan together for it. And that's what the show is here for, to get you thinking more seriously about it. On today's show, we're going to talk about the importance of rebalancing your accounts. When and how often should that be done? We're going to tackle the A word, annuities. Are they good, bad, or somewhere in between? And why you may not need fabric softener and how that actually ties into retirement planning. But first, here we are just weeks into 2022, and it's so hard to read the economy. The stock market continues its sharp ups and downs as it reacts to inflation and the likelihood of interest rate hikes by the Fed. And who knows how the next chapter of the pandemic is going to read. U.S. Bank Chief Economist Tendayi Kapfidze tells Yahoo Finance, well, honestly, it's a pretty tough call.
Last 2 years have really taught all of us a lot of things can change and change very rapidly. And, you just have to look at, the Fed itself to see how rapidly things change and the way that the Fed speakers are now addressing the economy versus, just 3-4 months ago. So in 3-4 months, again, going forward, who knows where we could be. So, but there's a lot of risk and uncertainty to that outlook. And that's kind of what I'm trying to emphasize.
And again, that's coming from a chief economist, a quote unquote expert. Have you guys been getting a lot of calls from concerned clients who hear all this confusion? And if so, what are you telling them?
well, I think there's a lot to be said about what we're seeing right now in the markets. It's things that we've been talking about on the radio, for quite some time. Last year was a good year. We've had a lot of great years in a row that the market's been very cooperative. And, as markets continue to reach record highs, volatility is something that is normal. If we look at January, there's an old saying in our industry. It says, as January goes, so goes the year. So for those of you that are listening that maybe were a little bit concerned or still feeling a little bit concerned about, the recent volatility that we've had in the stock market, can be hopefully today a good show for you to take some notes and write some tips down and get some ideas to make sure that you feel comfortable going into where we're at with the markets and the economy, and make sure that you're planned and prepared for, what be coming ahead. But even if we look at it just the other day on, Monday, when I come back and I think the morning the market opened up over 400 points down. By lunchtime, it was down, over 1,100 points at one point. And then by the end of the day on last Monday, the market actually ended positive. So you do see some big wild swings. So some advice that I would give to you, our listeners, first of all, we've been through this before. Volatility is not something that, is new. In fact, if you look at drops in, say, the NASDAQ, 10% drops are normal on average once every 2 years. A 20% drop in the NASDAQ is normal once every 4 years. So it can be scary, but if you take and you step back out of it for a little bit, it actually can create opportunities. In fact, if I go back to the phone calls I got this week, not one client that I can think of or call that I had was a concern call. A couple of the calls that I had were, what should we buy? Where are the opportunities at?
Yeah, right.
And the market did create some opportunities that are out there. So I don't know, if you have any thoughts about the markets. I know I handle a lot of that too, Scott, but any thoughts that you have about, what's been going on? I know you and I actually had a conversation on Monday when you were asking about the markets when we were having our Monday morning meeting.
Mm-hmm. Yeah, I'm in a different boat than obviously you are. Turning 60 here in a couple of weeks, and I'm most people look at retiring at 65, or their plans are that. I'm looking to go to at least 70. Rest assured, to all my clients, I'll be around for at least another 10 years. But, for me, it was a concern because I see the volatility and the ups and downs and the uncertainty out there. And I'm like, okay, so Nolan, what should I be doing at my stage of life and investment? I don't have, 20 years to reinvest should things really take a turn for the downside. And the nice thing was you gave me information. You told me here's what we've got in place. The circuit breakers are in place and things like that for me. And I know that you do that for all of your clients. But it's scary. Even people that are in the business like you and I, it's scary for a guy like me to look at this and say, man, I just don't know what's going on. So it's comforting to know that I've got you in my corner to help out with that, and that's obviously what we do here in America's Retirement Headquarters.
Yeah, so I think, a big takeaway is communication first and foremost is
Absolutely.
a two-way street. If you have questions, whether you're working with us, you have another financial advisor, or even if you're a do-it-yourselfer and just want to get a second opinion, talk to a professional that can kind of help guide you. Listening to the news can really drive you insane because, in the morning it might be an article about today's the worst day ever to be invested, and by the end of the day, again, the markets are positive. And, market predictions are often very difficult. So when you're talking about the communication and you're working with a professional, I think the first thing that you need to understand is what is the methodology or what is the philosophy within the plan. So as an example, one of our flagship portfolios called our King's model, we have about 60% of the portfolio in strategic asset allocation, saying that over time we believe the market will go up. And then we use about 40% of the portfolio in more tactical, which means we have the ability to look at market conditions and be adaptive and make changes. So as risk gets elevated, then what we can do is put more protection in place. One of the things that we like right now within the King's model that we've used is a hedging equity strategy. So a lot of people may not be familiar with this. I'd be happy to share with you how we do it. But essentially what we do is we use a portfolio that focuses on the likelihood is the market's going to continue to perform well. So we're optimistic with that portion of the portfolio. And then what we do is we take a portion of the portfolio and it's invested into a strategy that says, if and when the markets go down and we have some type of like black swan event, we're able to put losses to another investor. And there's also strategies that would, buffer some of the losses and allow you to, eliminate, 15 or 10 or even 25% of the losses. So it is a way to be able to add some downside protection into the portfolio to kind of hedge it. The second thing that beyond understanding your methodology is to also understand, what stocks you actually own. So in like a couple of our portfolios, one of the things that we like is we like daily essential companies. So daily essentials are the things that people are using every single day. So again, if we go back to looking at January being a volatile month, I still got up in the morning and I brushed my teeth and I used, toothpaste,
Sure.
right?
Yep.
I put on my Hanes underwear and I got, to dressed up and went to the breakfast table and had my cereal and got all my supplies that I got from the local grocery store. So, when you own daily essential companies, regardless of the market being up or down, these are companies that are probably going to be here for quite some time. In a couple of our other models, the things that we really like right now are investing in companies that are in a good financial position. So we like companies that have high cash positions and low debt. So when you peel back and look at the layers of the investments that you own, I think you want to be able to take a look at understanding exactly what you own. Then, you really want to kind of line all that up with, how it matches up with what your risk score is. We use some software where we develop investment policy statements for clients. And what it does is it gives us, probable ranges of returns of what the outcomes of the portfolio could be. And then we could stress test it in different environments, like, if the market did have a major downturn, what does it look like? So again, while the markets are doing good overall for the last year, it's a good time to kind of evaluate where things are at. and be able to kind of take a look at your positions.
Nolan, I do have a question with that. I actually heard on the radio this morning, or actually the other day, I should say, but a phrase called shrinkflation. And they explained what shrinkflation was, and I'm like, holy cow, that makes perfect sense. So obviously with inflation the way it is today, like you said, your daily essentials, you go to some of these stores and you don't find any of the daily essentials on there. How does that impact these companies and, their valuations with the products are either flying off the shelves as soon as they come in or they can't get them? But they explained shrinkflation, and they were talking about cereal. What these companies are doing now is they're actually reducing the amount that you're actually getting in the box. Like cereal, it might be an ounce, and they said, well, 1 ounce is equivalent to a one bowl of cereal. So you're paying the same price. So the companies, these grocery stores and these companies are charging the same price, but they're lowering how much you're actually getting. A lot of people don't even realize that, don't even see it. They just go there and grab it off the shelf and away they go. But as you talk about the daily essentials, I just wonder, how does inflation impact these companies when their products aren't on the shelves?
Well, there's only been, some issues with supply chains. I mean, another perfect example is like chicken wings. I love chicken wings, and I probably eat them too much. But, there's been a big shortage of those. And if you look at the price of being able to buy those, it does get more expensive. And I would agree, maybe if you go to the big store and usually buy a roughly 50 bag, maybe they're now down to 40. And that's one of the ways that they're dealing with the shrinkflation that you're talking about. I think the big issue here is more so how it impacts certain folks. Like for me, working, I'm still in my income producing years. It's not to say that I want to pay more or get less when I go to the grocery store. But the biggest impact is probably those people that are in retirement time that are more on fixed income. They have to be careful in those categories. When you're looking at what you own and looking at stocks, and we look at like grocery store retailers as an example, we're trying to take a look at it from a balance sheet perspective. So again, we're looking at how much financial strength does the company have with their balance sheets with cash on hand and low debt. There's a website, if you haven't looked at, Morningstar.com. Morningstar does a really good job. They have a free version that you can go in and you can type in whether it's a stock or a mutual fund and get a lot of information about it. I have a paid-for edition of Morningstar, and one of the things that it does is it gives us a fair value. Using the fair value can be also another way, whether it's looking at a grocery store or whether it's looking at one of your stocks that you have, to determine, are you, according to Morningstar, being able to buy something at what they consider to be a discount, at fair price, or overpaying. And one of the things that we do is our investment committee meeting, we really want to be careful about trying not to overpay too much for the investments that we have. So as the fair value drifts higher than, say, 50%, that might be a reason why you'd want to look at some other alternatives. When you're looking at it and you're drilling it even deeper and you're looking at the impact of inflation and what inflation has historically done and what sectors has it historically done, it's had the biggest impact on high growth type companies. That's where you see a big impact. And if you look at the month of January, when you think of high growth companies, we typically think of things like the NASDAQ. That's really been the area that has been the most impacted because, as inflation goes higher, it's slowing things down. So it makes sense that it would slow down some of those growth-oriented companies and be able to have kind of a pullback over there. And, the small growth category over the last year, according to Morningstar, their market barometer has been the biggest impacted area. In fact, over the last year, as of the date of this recording, the small growth area is now negative in the last year, where all the other sectors that are out there and the style boxes remain positive. So hopefully that helps answer the question as far as where do you look and what sectors and daily essential companies have historically been more defensive. So as market volatility increases, daily essentials have also been more defensive as well.
You said a word there, Nolan, and I want to focus back on value, being able to determine the value of things. I think people out there, they know what their utilities are coming in, month in and month out, and how much they pay for entertainment. And, whenever Netflix goes up, you take a look, you go, well, is that still worth it to me? If it goes up $1 here and there, a lot of people, it's still of value to them, so they continue to pay that. But when it comes to their investments, it can be trickier to assess the actual value, if it is overvalued or not. And that's where, Morningstar comes in handy. That is where having a team on your side, like America's retirement headquarters, like the Retirement Guys formula, America's Medicare Associates, really comes in handy. Understanding what you own. If you're concerned with market performance and your advisor has been, less than present, hasn't really been proactive in speaking with you, maybe give a call to America's Retirement Headquarters, speak with them, and start developing that strategy so that when the market does fluctuate, you can do like current clients do and look at it as a growth opportunity rather than doom and gloom. 419-794-3030 is the number. That's how you get started. 419-794-3030. Now, rebalancing is the process of looking at your portfolio assets and determining if the allocations have drifted away from your financial goals, kind of going back to that value aspect. Morningstar's Amy Arnott says it's especially important when it comes to older investors.
So if you're approaching retirement age or already in retirement, you probably want to keep a pretty close eye on your portfolio allocations and make sure they haven't drifted too far away from the target levels that you have in mind. And the reason behind that is what we've called sequence of returns risk, which is the risk that your portfolio goes down right before you need to start tapping into it for retirement income.
Now, mind you, I don't speak to as many pre-retirees and retirees as you guys do, but I can't imagine a lot of them go, I want to keep a watchful eye on my allocations and see how they're doing and rebalance. It could be a daunting task if you're doing it alone. I'm sure there are people out there who want to, but for the most part, I would assume not a lot of them. So doing it by yourself can be tricky, but that is something that you guys do. It's in your wheelhouse, right? How often should somebody re-examine their allocations?
Well, I would tell you that, next month in February will be the 27th anniversary of me being in the financial services business. So, we've seen these type of environments happen. I've been through 2008. I've been through 2000. What's really interesting is there's a lot of folks that, have forgot about 2008 and they forgot that those type of environments happen, which is why it becomes so important to rebalance. And just as they were talking about there, it becomes even more important to take a look at it for folks that are close to or in retirement time. The sequence of returns risk is such an important risk to take a look at. In fact, I developed a calculator that we utilize when we're looking at sequence of returns. So in traditional asset allocation, what they're looking at is what is the mixture between stocks and bonds. And so the thought process in the traditional asset allocation approach would say that, as you get older or less risky, you want to put more money into bonds and less money into stocks. Well, that approach that was created decades ago, and we flash forward today we live in a world that, bond interest rates are so darn low. If you really increase a dramatic position in your portfolio into bond funds, you may not have much of an opportunity. There at the same time, if you have too much money into the stock market right before or right after you retire and the market has a major downturn, you may not have the luxury of time to recover from those type of losses. So what we do in our approach and how we're a little bit unique is through our independent income system is we try to develop different buckets of money that are designed for different time frames. When we're thinking about when to rebalance, I would tell investors to rebalance, really maybe every 6 months. If you have a solid portfolio and you understand what it is, you don't need to be looking at it on a regular basis, and you don't need to be making changes on a regular basis. Maybe every 6 months would make sense. The other time you may want to consider rebalancing is when markets reach certain points. So one of the things that we have in one of our strategies is when the market is 10% above a moving average would be a time that historically we take and look to remove some profits from the market and try to protect them. The same would be true, if you're brave enough and when the markets pull down and have a downturn, those are the times that you want to increase your allocation and buy equities because, again, we've been through this before, and what history would say is if you buy low, you have a good opportunity that as the rebound happens, you'll get higher. And it's interesting, though, it's only in the stock market that I can think of that investors don't work that way. when we think about whether we want to buy items back at the grocery
Sure.
store or whether
Mhm.
we want to buy, clothes, we always want to buy things that are on sale and discounted prices. We want to use coupons, but the stock market, when the markets go down, that's when people want to try to sell. And when prices are high, they tend to chase those results, which history has proved that can be very, very dangerous to do. So again, rebalance when market conditions exceed a predetermined level, either on the up or down. And also, you could rebalance on a set time schedule, say every 6 months or every 12 months.
I think that's what I was doing in our meeting the other day. I was checking with you to kind of make sure I was doing the proper rebalancing of my accounts. Like we've said many times, when you get 62 to 65 years old, you're getting close to that retirement age, and you got to make sure that what you're doing during that period. We said before, you need an advisor that's going to get you to retirement, and then you need to change gears to get through retirement. And I think that's very important.
And again, that's the difference between the accumulation phase and the distribution phase, the retention phase. And that's why this show is called America's Retirement Headquarters. That's why it is the Retirement Guys formula, because this is the next chapter of your life. You want to make sure that the money lasts and the plan is solid, and you don't have to worry about unretiring, because I think that's also something that nobody out there really wants to do. Give a call, schedule a time, speak with America's Retirement Headquarters, 419-794-3030, or go online to americasretirementheadquarters.com. You can learn more about the independent income system right there at americasretirementheadquarters.com. Now, one of the most misunderstood planning tools in retirement, I think, is the annuity. And I'm guessing we've got people listening right now who have questions about how they work, but maybe they're a little hesitant to reach out. So I was wondering, as we wrap up the show here, if you might take a couple of the most common questions that people ask and answer them for us.
Yeah, absolutely. Well, the first thing I would say is there's no Swiss Army knife approach when it comes to investing. There's a lot of people, if you do Google searches, that would say annuities are the worst thing ever, and they want you to put all your money in the stock market. There's also, certain agents or insurance people that should say and want you to put all of your money in annuities. Annuities are a good tool if used correctly. And what I think oftentimes people do is they lump annuities into this all-encompassing bucket. It's like saying stocks are good or bad.
Mhm.
There's good and bad stocks that are out there. We can break down annuities into, I would say, the three most common that are out there would be called variable annuities,
Mhm.
fixed index annuities, and a fixed annuity. So a fixed annuity is very simple. It pays you a fixed rate of return for a set period of time. This would be most commonly used as an alternative to, like, a bank account or some other fixed account where you're trying to earn a little bit more interest. You know exactly what your interest rate is and how long it's going to be paid. It's pretty, straight, simple, and to the point. On the flip end of the scale, you have something called a variable annuity, which has been an extremely popular product that's been sold by, in my opinion, a lot of salespeople using variable annuities. What a variable annuity means is the markets can go up and down, and the account value will go up and down. You're usually adding on some type of rider, like an income rider or a death benefit rider. So in my opinion, oftentimes variable annuities are one of the more expensive financial products that are out there, which is why we have historically not used a lot of variable annuities except in selective situations. Income is probably one of the primary objectives for somebody in retirement, right? They want to generate income.
Sure.
And if somebody is worried about the stock market, but they want to have some protection that says, if the market, doesn't work out the way that they want, and they want to have an income protection, that's where somebody would look at some type of income guarantee. You think about when's the best time to buy insurance. It's, before you have a car accident,
Yeah.
before your house catches on fire.
Yep.
So with the markets at a record high, I would say there could be reasons to reevaluate, having an income rider and some protections while the markets are at record high. And the third category is the indexed annuities, probably one of my, favorite vehicles to use within the annuity product space. What a fixed index annuity does is it allows an investor to participate in a percentage of the market gains if the market goes up, but be protected against losses if and when the market goes down. So we would oftentimes use this as an alternative to, like, traditional bond funds or some of the lower interest rate fixed income investments that are out there, giving the investor much more opportunity to participate in growth while having the safety of principle of the portfolio to not go down. And what you'd find in a lot of these accounts is, they don't have those high expense ratios like what you'd find in variable annuities. So can be a product to consider. And again, when you're considering where you're at in retirement time, in this world, in this environment, with today's topics of looking at rebalancing, making sure that you understand what you own and understand your methodology. Again, as January goes, so does the year go. And as January's gone, it's been kind of a wild ride so far. So anybody who's listening, if January's got you a little bit nervous, we'd love to talk. That's what we're here for. So if you're a client, please get on our schedule. I'd also like to make sure that I invite you out to our Economic Summit that's coming up. Our Economic Summit is going to be an incredible event. It's the Beatles Love event on March 8th. And that's going to be held at the Hilton Garden Inn. Reservations are required, so everybody can get details on that and register online at our website, americasretirementheadquarters.com. And also, you could just text LOVE to 419-909-3828, and we'll send you an RSVP link that you can sign up for that event too. So we've got a lot of great things coming up, and we're happy to always educate you about today's environments and today's markets so you can make smart, educated decisions about what to do with your money in today's kind of crazy world that we live in.
So again, if you have questions about things that we talked about on this week's show or things that we didn't get to that you're still curious about, it's really easy. Go to americasretirementheadquarters.com or give a call, 419-794-3030. We appreciate you joining us this week, as we always do, taking a little bit of time out of your week to spend with us here on America's Retirement Headquarters. Nolan and Scott, glad to be with you guys again, as always. And as we wrap up, I'm going to leave you with the final word.
Well, I'd say retirement is the world's longest coffee break, so enjoy your coffee.